Good morning. You're watching The Market right here on ET Now with me, Aisha Faridi, Nikunj, Dalmia, Aman Dabash in the studios, and largely stable. That's how the handover was for the week gone by. We did pretty okay. We were up about over 1%. Yes, we didn't quite match up to the move that we saw in our global counterparts, but nonetheless, a decent move. We managed to finish above the 22K mark. And yes, large caps led by autos and PSUs, they continued to lead. Having said that, metals FMCG did see a bit of a retrace. But the big question now is, will the Nifty build on to the gains from last week, or are we going to consolidate here for some more time to come, considering it's been quite a range-bound move and finally we've seen a bite-up coming in last week?
I think that will continue, Aisha. I don't see a reason why markets really should gallop from here, and largely because you are now reaching that patch of no news, no results, nothing on the horizon in terms of global cues. It really would be a function of flows and liquidity and technicals. Flows are at best neutral. Liquidity is decent, but liquidity is not abundant. And then if one looks at the technical picture at high level, there is more supply than demand. So to make a case with the current set of cues that markets are going to gallop from here looks difficult. I guess the strategy in this market really is that you buy on a bad patch, you sell when there is a good patch. There's nothing wrong with the setup of the market. However, incrementally, more than upside, you're actually seeing mean reversion which is happening. It's happened in PSU stocks, it's happened in railway stocks, it's happened in a lot of stocks. So I look at the market very differently from what it was, let's say in October, November and December and Jan. The market positioning in the month of Feb is that while Nifty has cushion on the downside, it has resistance on the upside, but there are a lot of individual stocks which are going through a process of de-rating and mean reversion. Not many stocks in the mid and the small cap stocks are going higher. In fact, a lot of high flyers are actually getting grounded. So that's a difference. October, November, December, mid and small cap stocks were flying. January, February and beyond March, I think a lot of these high flyers now would be tested both in terms of earnings and also in terms of momentum.
Okay, perhaps that is going to be the course of action for the markets as we proceed. But nonetheless, on Friday's trading day, we did manage to gain about 0.5% at 22,040. The other big talking point then is clearly Paytm, and it was on the 13th of February that ET now came out with the news break that the Paytm is in talks with 5 lenders for a partnership, and now the news break has been confirmed. They have tied up with Axis Bank for merchant payment settlements and the nodal account for Paytm payments banks. And when it comes to the brokerage community, Nikunj as well, you still have about 69% of the brokerages, about 43 of the brokerages still having a buy rating on Paytm.
See, Paytm, you must realize that they've got a lifeline from Reserve Bank of India. But that does not mean that they are out of the woods. Just because you got a lifeline does not mean that it's going to be back to where the setup was initially before the RBI probe came out. Look, Paytm has an existing business, and that existing business has value. And if they're able to, in a sense, forge a lot of partnerships with other banks like Axis and one or two other large banks, then in the near term, that really could be the real hurrah or the real trigger for Paytm as a stock. Also, you have to remember that Paytm has a business and as a brand which is real. So what has happened, I guess, last week, both in terms of reaction and in terms of panic, I guess was very exaggerated, purely looking at the price point. I look at the Paytm stock moving actually with an upward bias rather than a downward tilt now. Paytm stock could see volatility. You should be prepared for wild swings because the price discovery will start. Is it time to go contra into Paytm? Well, if you're a high risk investor, maybe yes. But if you are looking at exiting Paytm sub 400, sub 500, I think you should wait it out. My only fear with Paytm is that when the stock will stabilize, there will be a lot of institutional selling which automatically will come in, because there are a lot of institutional investors who own Paytm. This is not a retail dominated or a promoter dominated company. So after, when you see this kind of a setup, because of compliance problem, because of what institutional investors follows in terms of a grid, the supply for Paytm actually would be large. So I get a sense that for Paytm, the downside really could be defined in the near term. and the upside in the near term also could be there looking at the news flow. But once Paytm goes up by 15-20%, the supply from institutional investor is something you need to watch out for.
Okay, that's the take coming in on Paytm. Just looking at what the week ahead is going to look like. While, of course, major queues in that sense have dried up, we got no earnings now to fall back on. But you will have a couple of IPOs which are going to be out. There'll be the FOMC minutes as well, which the market is going to derive its data from. And yes, news flow in that sense is going to dry up in terms of the macro cues that we may want to look out for. Now it's going to be very day-to-day company-specific news.
And even company-specific news, I think, would be largely news-driven because numbers are out. Earnings are out. You pretty much know what the bent of the market really would be. So it's technicals and flows. And rather than a lot of, rather than a lot of re-rating in stocks, my sense is that you are in for price adjustment, at least in some of the mid and the small cap stocks. If one really looks at what's happened to the small caps index, let's say in the month of Feb, let's look at it. The small cap, the bank Nifty, the mid cap, and the Nifty. Let's just look at it. Now that's the setup in terms of what the week lies ahead. Nothing much in terms of a specific news. The small cap index in this month has done just nothing. Similarly, the mid cap index in this month has given you what, like a 2% return, which is frankly not bad. And the bank Nifty and the Nifty also has been just absolutely flat. I mean, thank you to Reliance, Nifty has outperformed. But that I think clearly seems to be the setup that large cap stocks have started outperforming selectively. Mid and small cap stocks, if you look outside the index, that's where serious price adjustment is happening. I'm not making a case that markets are going to come down and fall flat. But I guess in a week where there is no news, in a month where hardly any cues are left, I guess a lot of price adjustment, a lot of high flyers, I think should be the order of the day.
All right, there you have it. That's the view in terms of the cues and the week ahead. Well, let's put the spotlight on the global commentary as well. You do have a truncated week for the US markets. They will be closed today, but for the week gone by, you did have the three major indices break their 5-week gaining streak. This morning, Asia largely is looking a bit mixed but somber. Let's get in Vinny then to wrap up all the global commentary. Vinny, morning.
Good morning, and let's start with the commentary that has come in from Federal Reserve Bank's Atlanta president, that's Bostic. And what Bostic is talking about is that, he's going to be supporting at least the beginning of the interest rate cuts, and that's going to be at some point of time in this summer in the US as well. So that's what he's keeping an eye out on. And he's also saying that earlier interest rate cuts would be something that is possible if the inflation data points actually start supporting that and warrant an early start as well. So data points are going to be key to watch out for interest rate cuts. Other than that, let's talk about the commentary that has come in from Bank of England's chief economist, Bill, who's highlighting the point that in terms of the interest rates can be reduced, but that is still some way away. There is still some time maybe for that as well, and they will continue to maintain the restrictions until they see the inflation actually coming out to that level. But yes, it's on the cards, at least is what is highlighting in terms of the interest rate cuts as well. Let's move on and lastly talk about Peter Schiff's commentary that is coming in. He's being again a bit more cautious in terms of the inflation data point actually reaching to the 2% mark. He's like, do you think it's actually going to be reaching that mark anytime soon, given that he's seeing a surge in the deficit spending as well as the consumer borrowing, so indicating a bit of a weakness that we've seen also coming in from the manufacturing side as well. So he's concerned about actually the inflation reaching the 2% Fed target as well, and he's saying that likely it could see an inching up and higher up, moving towards the 9% mark again, but he's concerned about the inflation going up as well. But he's saying that the Fed and investors have to keep an eye out on that and buy gold, again being quite bullish on the gold side.
Okay, let me also welcome on board our chartists and figure out what the trading texture is going to look like for the day and the week ahead. We've got CA Rudramurthy as well as Naresh Mirani joining in on the show as always. Naresh, Rudra, hi, morning. Good to have you both on the show. Naresh, let me start off with you. Not bad. We've made it to 22K. What lies in store ahead?
So the next number would be closer to 22,500, 600 as a target. And once we cross 22,100 and a little bit of a help from heavyweights, that should be the target we should be looking out for. And we've had a consolidation on the Nifty. We've stayed range bound for the last few weeks. So that sets up well for a move towards the 22,500 mark. And we have started seeing leadership coming one by one. So we had Reliance Industries. Now we are seeing a bounce in HDFC Bank. And now we are left with ICICI or Kotak to also join in the rally. So overall, the bias remains positive. Stock-specific momentum continues. So a hold across the board.
Okay, it seems to be a hold across the board. Rudra, let's get in your take as well. 22K managed to be maintained on the index, but the question is, are we going to see a bout of consolidation from here on, or will the Nifty continue to build onto its move?
Good morning. I fully agree with Nuresh. For me, even there has been a strong base formed both in Nifty and Bank Nifty. Now I feel HDFC Bank will lead the entire Bank Nifty pack on the upside. And after this consolidation in a tight range, what Nifty and Bank Nifty have seen, I feel it is just a matter of time. Might be today itself, we will take off that all-time high around 22,125, which is there on Nifty spot. And once we cross that, a clear 300 to 500 point kind of a move can come on the upside on Nifty. So very likely to see that break today at around 22,125. And yes, index is headed towards levels closer to 22,500 on Nifty. And if you watch Bank Nifty, again, levels around 44,800 has been a strong support. And today, if we see that close above 46,200 and we move towards those levels closer to 46,800, 47,000, yes, a fresh up move can be confirmed. And even Bank Nifty will very quickly go towards those all-time high levels of around 48,500. And this time it will be HDFC Bank which will support the move.
All right, let's get stock specific then. And Naresh, your strategies for the day?
So first is the buy on HDFC Bank. The stock has given first indications of a reversal in the last few sessions, as well as if you look at the last 4 years, the performance has been nothing to talk of. The stock used to be 1300 pre-COVID, pre-demerger, post-demerger, 1300, 1400 has been the base. So we are into that area from where ideally a bigger bounce would also be in play. But taking it step by step, expecting first a test of the gap down, a stop loss at 1395 and a target price of 1480, 1500. Second is a buy on SBI Life. Now, clearly the stock has been the leader on the insurance pack. We've seen a lot of insurance names continue to go sideways, drift lower. But SBI Life clearly continues to be the one which has been the first to hit the 52-week highs, give a breakout, consolidate, again give a breakout. So we saw that breakout earlier at 1350. Now we've seen a fresh breakout of 1500 levels, a new 52-week high, new all-time high. Expecting this momentum to continue towards 1650, stop loss at 1480.
Okay, let's find out what Rudra is betting on. So Rudra, what is it that you're looking at when it comes to individual stocks?
I even have HDFC Bank as my pick, which Nuresh just now gave. For me, HDFC Bank is a very good trade at current level. Risk reward is very favorable. Stock has taken support at around 1370, 1380 zone. And now having moved above 1400, yes, it will now first test 1460, which has been earlier support, now acting as resistance. And once it crosses 1460, yes, stock can move towards 1500 also. And don't short bank when HDFC Bank is on the upside. So Bank Nifty is also very bullish, looking at initial target of 1460 on HDFC Bank with a stop loss of 1410. And for me, Coal India also looks very strong. If you see the chart pattern, yes, stock made an up move, higher top, higher bottom formation, and then made a small consolidation. Now again breaking it out of those levels of around 480. So for me, keeping a strict stop loss of 470, Coal India is a buy for an initial target of 510, and eventually yes, 540, 550 is also possible on Coal India.
Okay, let's move on and let's talk about individual newsmakers this Monday morning. Anisha is here to flag off the same. And Anisha, let's start off with Quest Corp. Demerger, split into 3 entities. Walk us through what's the plan.
Well, value unlocking is what they are potentially doing, and the street is clearly excited about that one. But just to put the details into context, the company is splitting into 3 companies: Quest Corp, Digitide Solutions, as well as Blue Spring Enterprises. Quest Corp would be that mainstay workforce management business which will have the general IT as well as the staffing operations, even overseas at that. Digitide will include the global tech solutions, and Blue Spring Enterprises will be the operating asset management company. As far as the shareholding is concerned, there's not going to be any change in the shareholding pattern. It will be a pure 1:1 kind of share that the new entity, that the shareholders will get for the new entities. Analysts are seeing that as a big positive because this will be a value unlocking play. The demerger will streamline and simplify the business divisions. It will facilitate the deeper focus on segmental growth, help to de-risk the business as well as the inter-business dependency will come down. And Quest Corp, of course, has the largest revenue from the three entities, and that's why the street is going to bet big on that. In fact, Nuvama has written a note. They're fairly positive about the company. In fact, they're saying this demerged arm, which will be the staffing business, itself should command a valuation that the current market cap of the company has. So there is that bit of value unlocking which is possible, and that's why they've raised the target price to 630. They are saying for the other two business, the street might not be as excited because they're slow growth, but do remember for them the margins is on the higher side. So definitely a good play coming in there, and Quest Corp in focus on account of that, Nikunj.
So Nisha, the objective is simple demerger. You're taking the cyclicality out, what you've just flagged off, and you're looking at various sum of parts. What happens typically in a staffing business is that now cyclicality is at play. For example, 3 years ago, if you had large business coming from IT, well, that's taken a backseat. Similarly, for next 3 years, if you've got large business coming from manufacturing, that will take a front seat. So what they're essentially doing is they're unlocking the valuation. Sum of part for a good company, historically, if the businesses are growing, it has always created more value, and there are a lot of examples, and the one which pops up to my mind immediately is Geo Financials, that how a business was incubated and how it has created value. So I think for a management of this pedigree and the businesses which they represent, the attempt here is to create value. Also, you take the cyclicality part out, and also these businesses, Anisha, do not require a lot of cash, and they are businesses which are self-sustained. So I don't think there is going to be a shareholder resistance per se that you've taken the good business out, you've kept the small business in, what are you doing? You've taken the milk, the cash cow out. So I don't think all that issue really would also surface up. This is pure attempt towards creating value by unlocking subsidiaries and taking the cyclicality out for individual shareholders.
Okay, that's the view on Quest Corp. But the other one then to watch out for is MCX, and UBS coming out with their report. They've upped the target price and saying that even the PE is justified.
Yeah, it trades at an expensive multiple of almost 40 times, but they are saying this kind of valuation is justified given the growth prospects that the company has for now. The stock has already seen a run-up of 130% in the last 6 months, but they're clearly saying there are more legs to the rally. Their title says not over yet, maintained by. In fact, they've upped the target price, as you mentioned, to 4,300 versus 3,000 earlier. Now, they are saying that, of course, this quarter Q3 was marred by those one-off expenses which were there in terms of the software cost plus some other issues. That is not expected to happen in Q4. So the worst is probably behind for the company, and from Q4 we'll see a sharp turnaround is what UBS is penciling in. In fact, the new product launches that have been there for instance, the energy mini option as well as other contracts and monthly bullion option contracts, that too will drive the near-term growth and profitability for the company. They're expecting the growth of around 20% CAGR for the next couple of years as well. So clearly looking good, and they believe that volatility that we are seeing in the market is going to support both volumes and realization for options. So clearly we might be bored of this volatility and this narrow band, but MCX and I know MCX doesn't trade in the equity markets per se in the sense of Nifty and Sensex, but even the commodity has been fairly range bound. But clearly that's good news for the volumes on that exchange.
Anisha, the stock is up over 100% in the last 1 year. It's trading at 40 times 1 year forward. And even if it, let's say, grows at 25%, for a stock to justify a P multiple of 40 times 1 year forward, maybe 25 times 2 year forward, you cannot say the stock actually is very cheap. Whatever points in terms of the volume growth which will come out for MCX, look, that is all work in progress, and that will take some time before they are actually able to see benefits of it. This construct, I think, was fantastic for MCX when the stock was at 2,500, not at 3,500. So for me, I would still say that I would use NSE as the benchmark to understand valuations for exchanges, and on that account I think MCX is higher than NSE, because in NSE the business is growing, the equity cult is growing, they're throwing a lot of cash. If you use that similar comparison to compare MCX and NSE, in that comparison I guess MCX is very expensive. You go to buy the stock when there is bad news in the market. For example, we got some bad news last week when they got a lot of issues in terms of exchange starting late. That day the stock turned volatile. So you want to buy the stocks during the bad patch. After 100% appreciation, if you're buying stocks which are trading at P multiples of 40 times, 50 times 1 year forward, then the margin of safety, I guess, is missing.
Okay, that's the day coming in on MCX. Anisha, thanks for flagging off all the stocks in news this morning. Lots more to come, but on the other side of this break, and the Modi guarantee is clearly acting as a major fillip for the PSU pack. Stocks are back on track, scaling meteoric highs, power, infrastructure, rail, or be it the banking names. Where is it that you should be focusing on? Here's a slew of market opinion on the same.
We have been talking about value as a thesis, and obviously PSU qualify as a value thesis right from September 2021. So it'll not be, we were relatively, as compared to somebody looking at the top, we are very early in identifying that inflection point, and I've been very bullish for more than 2 years now in this space. But we remain very constructive. If you look at the larger picture, we are looking for the PSUs, okay? Neither we get too complacent about the move which we happened very recently, nor we get too tense about what happened in last 2 or 3 trading sessions.
Sitting in the PSU, so we've been invested, in PSU stocks, especially PSU banks. We own BHL, we own HAL. So I think we participate in, and we really don't look at anything as a PSU or non-PSU. We look at wherever there's a transformation happening, especially, we take care and we like where there's a governance is in place, a business model is in place and evaluations are in place. Our biggest call has been that this bridging of the gap will create biggest value, and still we don't find there's a huge, still there's a lot of value on the table. If you look at it more.
I think there is a significant amount of froth in the public sector enterprise system. There might be some leaders which are still reasonably priced, but I think by and large it is my opinion that the public sector enterprise as a whole is quite expensive as a stock universe.
People thought that coal-based or thermal is going out of fashion, and those are the stocks that have done the best. Coal India is a case in point. BHEL has produced loss after loss after loss, but because of the future being what it is, it's trading at multi-year highs. NTPC has done brilliantly. So if you just take, without recommending a stock or two, if you just take some of the PSUs which have been laggards in the past, but efficiency will come when inefficiencies get dropped off. And I think that's the way people are seeing the sales of the world, BHELs, OMCs, etc., where going forward, inefficiencies are being eliminated, capex is coming in, and the CEOs and the management and the board are being held more accountable for profits.
Thanks for staying on with us. Still tuned into the market. Now let's put Paytm in the spotlight in line with what we reported on the 13th of February. Paytm has got a helping hand from Axis Bank as the fintech company announced that partnership with Axis Bank to shift their nodal account from Paytm Payments Bank to now Axis Bank. So what happens? What does this mean for Paytm? Let's understand the story and how it's unfolded up until now, especially after the extension of the deadline as well from the Reserve Bank. My colleague Ankur Mishra joins in with the latest. Ankur.
Yes, Paytm has got a helping hand from Axis Bank because it has tied up with the lender for being a nodal bank. Now, what does this mean? This means especially for merchants, be it payment QR, soundbox, card machine, all those can be functional, where earlier Paytm Payments Bank was involved. Now it can be exchanged with Axis Bank. Now apart from that, Paytm has also mentioned that it is continuing to having talks for partnership with other lenders as well. And as far as the deadline of Reserve Bank of India is concerned, now on Paytm Payments Bank, that deadline has been shifted to 15th of March from February 29 earlier. Specifically, if you talk about a few of the services which were provided by Paytm Payments Bank, and among them the most important question which is asked often is about FASTag. Now what happens after the deadline? Reserve Bank of India has clearly advised to customers that you need to shift to other payment banks where FASTag is involved. However, whatever be the balance in FASTag, that can be used even after the deadline. Similarly, For wallets as well, it can be utilized even after deadline, but there will be no top-ups which is allowed after the deadline. However, there is one concession which has been given by the regulator, and that includes if you got any of the cashbacks which is remaining, which may come after the deadline, that is allowed by the regulator.
Okay, that's all you need to know on what's going on with the Paytm saga. Let me also welcome on board Sanjeev Bhasin and find out what he's making of the market. Sanjeev, hi, good morning. Good to have you on the show. Sanjeev, let's start off with Paytm. I know you've been holding the stock and I know you think it'll all find its way eventually. But curious to know whether in the recent decline you've added any positions.
Yeah, good morning. No, Aisha, we've desisted from that. In fact, we've added our position in PB Fintech. Like I told you, PB Fintech, Paytm, and Zomato we hold in, in likewise quantity, and the other two have outperformed, and this one has underperformed. So we'll wait for more color. As you are aware, there are a lot of foreign institution investors, and the clarity has not been so forthcoming. So we are aware of the downside in the sense that most of the negative news is getting priced in, and people who had to exit. But let's wait for more color. The management sounds very optimistic that they have been able to retain a lot of the positives from the RBI FNCO. And from what I learned, that the ED has found nothing untoward towards anything to do with FEMA or what we call Hawala or something like that. So I think it is better to wait for more color. Paytm, the QR, the soundbox, all those are as good as they've been before. And we'll wait for more language, but we will not enter. It's not worth putting good money after bad till you get more clarity. So we are desisting from adding any position. We'll wait for more clarity and then only take a call on that.
Okay, makes sense. That's the call coming in on Paytm. Also, a nice move, Sanjeev, on Friday in some of the smaller pharma names led by Ipca Laboratories, Glenmark, Biocon, of course, as well, held out very nicely. Anything within pharma which is a buy call?
Well, we've had Ipca and Glenmark from much lower levels, close to 550 on Glenmark and close to 820 on Ipca. We still think that is a very sweet spot, as are the mid-cap IT plays. But, I think the earnings have been supportive of their growth. And this was a misnomer that after COVID, they will be downsizing. I think pharma has been one of the best indices along with IT. And I think now it's the turn of metals to start roaring as China comes back. So as a disclosure, both Glenmark and Ipca are in our portfolio along with Dr. Reddy and Cipla. And Lupin has been our dog horse, which are almost doubled and still looking good. So I will go with Lupin as my top play in pharma.
Okay, Sanjeev, hi, morning. Wanted to get in your take on MCX as well. UBS upping the target price and saying that at 40 times the valuation is justified because the growth part looks strong. Your view on how things have unfolded for MCX?
Yeah, good morning. So Avan, MCX was very, very sweetly placed at that 1800. At 3400, it is 3500, it is more than doubled. But see, 5 themes are there for the next 20 years. Exchanges, depository, stockbrokers, as in where I come from, insurance and AMCs. I think this business is irreversible. And as you see the premium on the NSE also start to be slightly on the upper side on the unlisted space. I think the best play here is MCX. We have a contra call and a buy on IEX, and we think that people are ignoring the woods for the trees. They are missing the woods for the trees. IEX is having 85% EBITDA on its turnover on the margins, and what will happen? There may be plateauing of the rates, but the volumes in the next 3-5 years will be 10 times what we have seen. So I think IEX is a dark horse on the exchange, and power exchanges are here to stay. So MCX, like we said, is in our portfolio, but IEX is something where we have put a lot of money around that 120, 125. We think this is a doubler in the next 1.5 years.
Okay, fair enough. Looking at IEX, giving a thumbs up on that stock. Just wanted to get in your take as well on the entire cap goods space. Just today, there's a Citi report on Cummins as well, where they're increasing the target price. If you had to cherry pick, Sanjeev, especially with this overall capex thrust, manufacturing boost, etc., where is it that you would be placing your bets?
So 5 stocks which we've been very, very bullish and which we own ABB, Siemens, L&T, Cummins, and Thermax. We are very bullish on all those 5 names. And, you can do your picks and chooses. These are not cheap stocks. They've been hitting new highs, but it's telling you the underlying effect of capex coming after 20 years, where these companies are now cash generating like never before. Also, most of them, like Cummins, ABB, have no need of debt. And that's why the return on capital is, they are expensive stocks, but will continue to remain on that basket. So buy a basket of these 5 or buy some mutual fund which has exposure more towards capital good stocks, because individual stocks may or may not make it to your desired levels of profits.
Sure. Okay, let's address another newsmaker. And Bloom Energy, the largest client of MTAR Technologies, has reported weak earnings. Now, how is that going to impact MTAR? Anisha is here with that perspective. Anisha?
Oh, well, yes. So Bloom Energy, which is listed on New York Stock Exchange, was actually down 18%, and that's because the earnings were rather weak and they've painted a bleak outlook going forward. As you pointed out, it's important for MTAR Tech because Bloom Energy is one of the large clients, and the stock had reacted very positively earlier when the company had been consistently getting orders from Bloom Energy, and every time there was a good earnings from Bloom Energy, there was a consequent impact. So we are expecting probably a negative impact as well to fall into the stock price today. Now, as far as Bloom Energy's earnings are concerned, they're talking about weakness which is evolving due to the CHPS, or the Clean Hydrogen Production Standard in Korea. They did not report any data center bookings and traction, and it's unlikely to happen in the second half of 24 as well. The CFO also announced departure, which is a bit of a negative, given he was the guy who was focusing on the margin improvement in the near term. Going forward, they're expecting the revenue of $1.4 to $1.6 billion as compared to the street expectation of 1.73. So there's a bit of a miss when it comes to the expectation for the rest of the year is concerned as well. For FY25, the revenue from Bloom was estimated to be around 33%. Earlier, this number used to be 65-70%. So that has been brought down to 33%. And in FY25, the estimated 300 crore order, which is there for MTAR, is something to watch out for, whether there is a delay in the execution of this 300 crore order or not. Remember, MTAR, as it is, reported very bleak earnings in the week gone by. The revenue was down 36%, the EBITDA had got eroded by 88%, and the profitability was also sharply down. And this is coming in as another nail in the coffin. Let's see how the stock reacts today.
All right, thanks very much for giving us that roundup. Sanjeev, care to comment on some of the data that was just flagged off by Anisha with respect to, the impact on MTAR Tech?
No, we have stopped tracking the stock. That stock went out of our realm and it came down for reasons when the promoter sold. We bought some of it and we encashed. Avan, we want to stay with large caps. So in large caps, we continue to be overweight on HCL Tech. Tech Mahindra is another stock which I think can outperform, and Persistent and Coforge are 4 of these stocks which we are very bullish. Look, IT is been a star performer along with the pharma, and I think they will continue. But look for good names. Tech Mahindra has undergone what it had to in the BFSI space. They are seeing a lot of traction. The new change in management is very, very optimistic. I mean, they are now aggressive in their forthcoming bids. And I think Tech Mahindra can be a relative dark horse. Plus, we want to be in heavyweight. So HCL Tech, Tech Mahindra, Persistent, and Coforge are 4 stocks we would recommend. MTAR is not something which we are very gung-ho over. After the recent run-up, we think there should be some, plateauing over there for some time.
Okay, that's the take coming in on what to pick out for, and technology continues to be a favorite with Sanjeev. And Sanjeev, have to discuss PSUs and have to get your top 3 ideas from there where you still think there's value on the table. I know you flagged off power as a sector already, but aside of that.
So Aisha, first we'll go back a month back when 3200 was, or 3300 was where 3700 was where Hero Motor was, and there was a downgrade to 33 or something, and and I said 5,000 is coming in Hero Motor. By the way, we hit 5,000. On 14,000, I gave 25,000 as a target for Bosch, and people were laughing. In fact, it hit 28,000. So don't underestimate the power of a bull market in stocks and sectors which have not performed. Similar is the case with State Bank, Can Bank, PNB. 40 rupees is 130 and raring to go. And REC, PFC, every quarter the numbers justify the re-rating of the stocks. I am not advocating a full-fledged buy, but I still think there is room over there on certain stock sectors which can outperform. So do your whole homework. I still think in the large cap, NTPC is a stock which you must own. Now, whether you buy it at this price or slightly lower, it's all up to you. And like I said, Aisha, the comeback in commodities is now going to be a play on China. I would be very, very bullish on metals. And Tata Power continues to be one of the best picks over there, but on declines.
All right, thanks so much, Sanjeev, then for joining in and giving us your take on the overall markets and individual stocks. Meantime, Rudra, let's understand your outlook then on how you're looking at some of the heavyweights within the banking space and what's the reading on the Nifty Bank Index?
See, for me, first of all, HDFC Bank looks very, very strong. It has made that bottom formation at around 1,373.80 zone. And for last two trading session, if you see, yes, there has been a clear accumulation happening in HDFC Bank. And if you see shorter time frame chart, definitely things are very positive. Yes, it has to test those levels closer to 1,460 to 1,475 initially, which was the previous support and now acting as resistance. So first, let me see the move to 1,460, 1,475 zones on HDFC Bank. And if it can cross those resistance zones at around 1,475, yes, stock can further go up and even test levels closer to 1,530 also. So for me, HDFC Bank will lead the move on the Bank Nifty, and Bank Nifty, if you see very clearly, has crossed the zones of 46,200, which was acting as a stiff resistance. And last two trading sessions, yes, there has been a buying which came from the lower levels. So for me, Bank Nifty is a clear buy. I will buy at open or on any dips to levels closer to 46,200. Keep a stop loss of around 45,800 and expect a big outperformance from Bank Nifty led by HDFC Bank. I see even SBI will support the move on the upside. It will still continue the upside momentum, and also ICICI Bank should continue its up move. So HDFC Bank, ICICI Bank on the private bank, and I see SBI continuing its support. So Bank Nifty is definitely headed upside, keeping a stop loss of 45,800. I'll be a buyer at current market price on Bank Nifty, looking at initial targets of around 48,000 to come.
Okay. Sandeep Sabharwal is not ready. Taking a bit long. Maybe must have gone for the squash game. I'll ask him. HDFC Bank, everybody is talking about. I'm just going to take my mic up also. HDFC Bank, everybody is talking about it. Are we at that fundamental turn for HDFC Bank? Whereas the other one which I think is worth revisiting is ITC. Bad stake, no stake. It's a bull market stock. And when a bull market stock corrects, you got to be a buyer there. I think 440 has become 400 or 450, 460 has become 400. I don't remember the exact number, but I think it's a sizable 10% correction which has kicked in.
So yes, technically the stock is coming back to an interesting price point. So if we go back over the previous rally, which we saw, the last time we saw a rally was from that 370, 390 mark where it was consolidating. And then we went up towards 490. And finally, it made a top around the buzz of the demerger. And now we are back to those levels. So actually at these levels, the stock looks promising for a slow and steady bounce back to 440 to 470. The only problem is how much time does it take for a bounce back and what is the relative choice one has. But at current levels, the risk reward is interesting, wherein I would keep a stop loss below 380 and buy closer to 390, 400 mark. So from here on, we could see a slow and steady bounce, and it's been a good enough correction. And time spent also has been decent. So the stock was last at 400 rupees back in April of last year. So it's been a 10, 11 months zero return for the stock as well. So a trending stock which went into a sideways consolidation, expecting it to bounce back.
Sandeep Sabharwal, good morning. You're running late. Early morning squash or late night party?
None of the above. More due to technical issues.
We have two technical experts here. We can solve all the technical issues. What are the technical issues?
Yeah, so I think it was a breakdown. So now they have to predict when the breakout will happen.
Where do you think, my friend, in the market breakouts will happen now?
Yeah, markets are interestingly poised because overall globally the equity sentiment is at very elevated levels. So if we see parameters which determine euphoria or despair, cash levels of funds have come down to nearly 3-year lows. The bullish sentiments are very high. And on the other hand, we have a situation where the inflationary trajectory also seems to be stalling globally in the sense that the declining cycle is stalling, so the easing cycle also might be postponed. So markets, I think, are fairly priced. They have factored in a lot of positives, and to that extent, significant upside on the broader indices side looks tougher. So I think it's a stock by stock approach now.
So what should one do then, Sandeep? Because there is this outside view, which is that, look, election is round the corner, never say never. Then there is this temptation to sell at these levels. Should one stay invested or time to raise cash?
Oh, I think it depends on how you are positioned. So I think for people who are fully invested, they don't have anything, they have made a decent amount of money, it makes sense to have some cash on the sidelines, because some cash on the sidelines always helps you whenever there is a corrective move. For people who are very less invested in the market and then still they are thinking what they should be doing, whatever money they have invested, I don't think it makes sense to pull out, because longer term picture for India, I think, is attractive given the fact that a 7% kind of economic growth outlook for 2-3 years at least, for now, seems to be very clear. And in an economy which at a now at a higher level now. So now, given the size of the Indian economy, a 7% real growth or a 10-11% nominal growth creates a significant amount of new GDP every year. So it creates a lot of opportunities for companies to grow and investments to have opportunities to invest. So I think longer term picture, I don't see an issue. But then uh, every bull market we've seen, any previous bull market also, when there's a correction, that correction also can be fast and swift. So whoever is investing at these levels should be ready for that kind of correction.
Scanning through the gainers and the losers, scanning through the gainers and the losers, and last week there's nothing which really stands out for me. We actually underperformed the regional markets, and it was not like a very dramatic kind of an underperformance. Sandeep, the theme last year was buy companies which will benefit when inflation is rising. The theme this year really could be look at companies which would also take advantage when inflation is stable and inflation is coming down. They are two very separate things, Sandeep. I'm just breaking it for our viewers that when you're buying companies which essentially benefit from inflation, that would include, let's say, commodities, producers. When you're buying companies which would benefit when inflation is stable, you essentially would say, I would buy consumers. I would buy companies which essentially have a large raw material cost which is coming in form of agri, or it is coming in form of metals, or it is coming in form of power. So Sandeep, for me that is an overarching theme. Bet on companies which will benefit when inflation is flat or down. How would you bet on that?
Yeah, it's perfectly right, and some advantage of those things we've seen over the last few quarters also, as for especially for companies which have been able to show volume growth. So, for example, the auto sector stands out there, where because there's been volume growth and raw material price deflation, they've been able to show significant improvements in profitability. Now, a similar thing I would think would happen in consumer durables as well as non-durables going into 2024, a later part of it, maybe not this quarter, going forward. Because even as we saw the results of many of the companies, let's say in the apparel segment this quarter, the fall in fabric prices, lower cotton prices, etc., have benefited on the gross margins. But the profitability at the net level, if you leave aside trend, has not improved so much because of the fact that the top line growth is not so much. But as the revival happens in the demand on the demand side, we'll also see that kicking in, and that will create a significant upside in terms of earnings. So I think beaten down stocks in these segments should be preferred at this stage.
Enough. Meantime, just taking a look at some of the brokerage notes this morning as well. And you've got Jefferies talking about their overall focus, which is going to be on energy, metals, autos, and the pharma sector when it comes to the earnings performance down the line, saying that the FY24-25 EPS CAGR is projected at about 15%. If we were to, Sandeep, just take out the entire energy space, owing to the way we've seen, the likes of an ONGC perform, the kind of stamp of approval that has been given by the government, if I were to include even OMCs in this basket, what's your outlook for the year ahead, and even when it comes to earnings performance?
Aman, I don't buy these stocks because they are very prone to any kind of government action determining what earnings they can report. For example, this the tax on crude oil, the windfall tax, or the fact that suddenly in the run up to the election we could see significant fuel price reduction. So what it does to the profitability is very tough to predict. A stability in fuel prices has aided the uptick in OMC stocks, and everyone is turning very bullish on them. But I think there are risks on the horizon which need to be recognized. ONGC, it was very cheap, so it's had an uptick, but it's a very inefficient company in terms of any ability of it to actually increase production. In fact, it's been incurring thousands of crores of capex every year, but its production has actually been falling. Now they are predicting some uptick in production next year, but I don't think it's significant to drive such huge re-rating.
All right. Stay with us. In fact, let's find out what exactly the brokerage community has to say. Q3 has more upgrades than downgrades is what they believe. Which sectors have outperformed? What is the way forward? Let's take it across to Ashesha. She's analyzed some of this data and now joins in. Ashesha?
Well, yes, we have 3 brokerage reports that have come in this morning. First up, let's talk about Citi, where they say that post third quarter results, upgrades have exceeded downgrades across stocks under Citi coverage. Autos and healthcare saw earnings beats and earnings estimates revised upwards, while financials and materials missed estimates and downward revisions were seen across these sectors. In fact, their Nifty target for December 2024 now stands at 22,500, 3% upside from the current levels. PSU utilities, defense, industrials, banks and insurance are their key overweight sectors, and consumer discretionary, IT services and metals are the key underweight sectors across their coverage. Jefferies also came out with a note where they say that upgrades are now at 9-year high levels across their coverage. FY24-25 Nifty EPS CAGR is now predicted and projected to come in at 15% growth. Energy, metals, auto and pharma sector earnings saw strong performance in the third quarter. Morgan Stanley, meanwhile, believes that margins expanded for the 4th consecutive quarter in the third quarter. Broad market earnings outperformed narrow market estimates, and materials excluding chemicals and consumer discretionary reported best ever earnings growth in the quarter gone by.
Isha, thanks very much for giving us that heads up. Meantime, Sandeep, let's also get in your take then. We were just talking about this big capex thrust and a push there. What is it that you would be looking at by way of individual opportunities for the long haul when it comes to the capex theme? If I were to say capex, what really comes to mind for you when it comes to individual stocks?
I think across the board, we are seeing benefit of the capex cycle among companies. So the largest player, L&T, is the biggest beneficiary, obviously. Then on the large cap side, we've seen ABB and Siemens deliver very strong numbers. And that's also driven the re-rating higher. So, but ABB and Siemens, I believe, are now trading at valuations which leave little upside in the near term. Then you come to companies like Thermax, etc., where also the valuations seem to be stretched. And then there are construction companies. So among the construction companies, I think there are few where I believe still the valuation growth paradigm looks attractive. One of those companies which we own is Ahluwalia Contracts, where the company has done very well and it's built up orders significantly, and its current orders plus L1 itself is around nearing 15,000 crores, which gives it visibility for 2-3 years growth. And valuations are still reasonable. So I think that's one company which we have, and NCC obviously we have, but there I think the re-rating has happened. Now it will be driven higher more by earnings growth.
Sandeep, but is that space in a good turn? I was looking at numbers from Ahluwalia. I think margins were 24%. 24% margins are enjoyed by FMCG companies. NCC you just mentioned. I was looking at notes from the con call of Capacitor. BL Kashyap numbers not bad. Is that space in some kind of a turn? I mean, what we call in Hindi the thekedari business.
Yeah, it's in a good space, especially because of the fact that the competitive intensity is reduced. And one of the very important facets which I have observed is, and which many of the governments, both state and central governments, are now driving, is that timely completion of projects, and which leads to timely realization of dues. Because earlier in this industry, the big problem used to be, even few years back, that every project used to be delayed, payments used to get stuck, etc., and that used to get these companies into problem. And that has got resolved to a very great extent. And that by itself is something which should actually lead to a re-rating of the sector.
62 points higher. That is what markets are indicating in terms of the SGX opening. Sandeep Sabral, always a pleasure. Thank you very much. Hopefully next time there are no technical issues.
Technical issues are not in my hand.
ये बिल तो नहीं दिया था ना, बिल तो दिया था ना. It is not like a bill late repayment, right?
No, it was more related to your Zoom connection.
Okay, no, I was just checking. Maybe you forgot to pay your bill. It's okay. All right, have a good day. Thank you very much for joining us.
Yes, bye.
Naresh, we've discussed Maruti a lot. Is Maruti headed towards 12,000 finally?
Now that's just 600 points away. Ideally, what has happened with a lot of auto names, once they've broken out, they've continued to surprise on the way up. So when we were looking at Hero MotoCorp at 3,000, 3,300, the stock has gone to 4,800. Same way, 4,000, 4,500 is where Bajaj Auto broke out. The stock went to 8,000 levels. Tata Motors, when it broke out from that 500, 600 mark, the stock has gone to 900 plus. So Maruti is a similar breakout to the rest of the names. And it's spent almost 6 years with zero return. So the stock was at 10,000 back in 2018. And the breakout took place last year. We went to 11,000, retested, and now finally the trend has started. We've gone above 11,000 levels. So ideally, a pure play technical target would come closer to 15,000 in the medium term. So the structure is positive, and for the last few sessions, it has clearly shown relative strength with the index as well as the auto index. So it still remains a buy on dips anywhere closer to 11,000, 11,100.
Let's move on and let's address all the other newsmakers and reports indicating that Dr. Reddy's could be eyeing to acquire Novartis's India arm. In fact, it seems that they're in race to acquire this stake. Let me take it across to Srishti and find out what both the parties are saying, because over the weekend, Srishti, there has been a clarification as well from DRL, right?
Well, yes, indeed. Dr. Reddy's has come out with this clarification, but the parent company of Novartis, that is Novartis AG, has come out with a notification announcing a strategic review of its Indian subsidiary, that is Novartis India Limited, wherein they currently hold a little over 70% stake in Novartis India, and they do mention that they are assessing the shareholding of Novartis AG in Novartis India Limited, and the strategic review will include the assessment of the shareholding, though there is no assurance that the strategic review of Novartis India will be completed in 2024 itself. And definitely the media reports are suggesting that Dr. Reddy's is in the race to acquire the stake in Novartis India. But Dr. Reddy's has also clarified that there are no such events as of now which needs a disclosure, and they would not like to comment on market speculation. But Nomura has come out with a note saying that this could make a sense for Dr. Reddy's, and they do see a strong possibility of Dr. Reddy's pursuing Novartis India. Dr. Reddy's is best placed to acquire Novartis stake in Novartis India. Why so? Because they already have an existing distribution partnership with Novartis India, as well as for the upcoming brands, this could make a strategic sense for Dr. Reddy's. Other than that, they do mention that the valuation though is high as of now, but the value accretion will be driven by the cost reduction, and if at all they further go with some acquisition in some of their brands, this would strengthen Dr. Reddy's India portfolio, as well as would get additional brands in neurology as well as oncology space. They also mentioned that all these products could be a low margin product, but the volume could drive the business for Dr. Reddy's, and that's why they have come out with a note and said that this could make a sense for Dr. Reddy's as of now, but the company has denied that there are no such events that needs a disclosure at this point in time, and that's why both the companies are in focus. But it's clear that Novartis India is on the block, and there could be some players coming in.
Thanks very much, Srishti, for filling us in with those details. All right, let's check in on the pre-open rates this morning, holding out at the 22,000 mark, but it's a very quiet move. Let's find out what the mid-cap strategies are. Rudra, what's looking good?
See, for me, I like Quest Corp, which is one of the stocks which has consolidated, and now it is looking good, and IT also performing well as a sector. For me, Quest Corp is a buy. I'll keep a stop loss of around 470 and looking at initial targets of 550 to come on Quest Corp.
Quest Corp it is, newsmaker today as well. And Nuresh, your top mid-cap recommendation.
So continue to like IDFC First Bank for the short term as the bounce back stock. The stock corrected from 100 all the way down to sub 80 levels. In the last two sessions, there's shown a recovery, a positive divergence on the short-term charts as well, trying to make a recovery. So expecting a bounce towards the last couple of months highs of 90, stop loss now at 79.
Okay, let's move away from what the equity markets are up to, and let's tell you all that's happening outside that world. And after the central government proposed a new plan for the minimum support price for crops, the farm leaders have announced that they will study the proposal in the coming 2 days and stated that the Delhi Chalo March has been put on hold till then. The next decision will be taken on February 21st. And the 12th edition of the Milan Naval Exercise is set to commence in Visakhapatnam today. The drill, which will go on till February 27th, will see over 50 countries taking part. The focus remains on forging naval alliances for a secure maritime future amid growing Chinese influence in the region.
Meantime, the India women's badminton team scripted history on Sunday in Malaysia. They won the Badminton Asia Team Championship crown, beating Thailand 3-2 in a hard fight-fought final. This is the first time that India have won this prestigious Continental Team Championship title in the history of the sport. Moving on then, you also had the spotlight on the BAFTA Awards. Christopher Nolan's Oppenheimer made a strong statement at the BAFTA Awards, bagging 7 trophies in total. This strengthens the film's prospects for the Oscars as well. Meantime, Greta Gerwig's Barbie was snubbed yet again. Poor Things won 5 awards at the BAFTAs in total.